So today we're taking a stack of your sources, specifically the historical notes, the financial analyses, and, the core philosophies around Jim Rogers' legendary book, Investment Biker.
Right, which is just such a fascinating collection of material.
It really is. And the mission for this deep dive is to basically uncover this radical, unconventional shortcut to finding hidden value. We want to rewire how you understand opportunity.
Yeah, by looking at the world from the dirt road up, rather than the penthouse down.
Exactly. But to really get there, we kind of have to start in the 1970s. So imagine you're sitting in this pristine corner office, right? High above Wall Street.
Oh, the dream scenario for most people.
Right. You have just co-founded the Quantum Fund alongside George Soros. And over the next decade, you generate the kind of just extraordinary astronomical returns that make you an absolute legend in the financial world.
You fundamentally won the game at that point.
You have. And most people in that position, they buy a private island, they play golf for the rest of their lives, or they just sit behind a massive mahogany desk managing their empire.
Sure, they get comfortable.
But Jim Rogers walks away. He actually walks away. He buys a BMW motorcycle, packs only the absolute bare essentials into the saddlebags, and just hits the road.
And he doesn't just go for like a weekend cruise either. He rides over 100,000 miles.
Which is insane.
Totally. He crossed 6 different continents. And that physically grueling, totally eye-opening journey is really what produced the data for the book we're unpacking for you today.
He didn't take this massive road trip just for the thrill of the adventure, though.
No, not at all. The core thesis here is a complete paradigm shift regarding information streams. He believed the best investment research doesn't happen behind a desk, analyzing sanitized corporate reports.
Right. It happens by stepping away from those conventional data feeds.
Exactly, by studying countries, people, and infrastructures directly from the ground level.
Okay, let's unpack this because the contrast is just staggering. You have the traditional investor glued to a blinking green screen in Manhattan.
Right.
And then you have a Wall Street titan literally covered in dust, kicking down the kickstand on a motorcycle in the middle of a foreign country. Why is that Manhattan desk so blinding to an investor?
Well, because when you sit at a desk, you're consuming a reality that has been heavily filtered. It's edited and delayed by the time it actually reaches your screen.
You're seeing the world exactly as everyone else sees it.
Exactly. And in investing, or frankly, like in any field where you're trying to find an edge, looking at the exact same data as the crowd basically guarantees you'll get the exact same results as the crowd.
Which is average at best.
Right. The illusion of being informed is really dangerous. The data on that terminal in Manhattan isn't reality. It's a representation of reality that's already stale.
Yeah, like when a mainstream news anchor reports on an economic boom in a developing nation.
The structural changes that actually caused that boom started years ago. The smart money has already positioned itself long before that.
So by the time a headline is printed, the opportunity is largely exhausted.
Pretty much, yeah.
I always think about it like relying purely on Yelp reviews to judge a neighborhood versus actually, walking down the street yourself.
Oh, that's a great way to look at it.
Right. Because you might look at an app and see a 2-star review for a restaurant from 3 months ago. The internet says the place is dead, the food is terrible, it's just a lost cause.
But the internet is lagging.
Exactly. If you actually physically walk down that street today, you might see a line out the door, fresh paint on the walls, and a new management sign in the window. The reality on the ground has completely changed.
But the latency of the internet means that reality hasn't been updated online yet.
Right. And if you wait for the 5-star reviews to populate, you won't be able to get a table. Markets move in the exact same way, don't they?
They really do. The real world moves long before the financial models update. What's fascinating here is how the physical act of travel transforms into this unparalleled real-time research laboratory.
Because financial modeling software just cannot replicate the sensory input of observing a country's operational friction.
Exactly. Think about the specific geopolitical markers you can only see on the ground. When Rogers would roll up to a national border on his motorcycle, the border crossing itself became this major economic indicator.
How so? Like, what was he looking for?
Well, if it took him 3 days of navigating bureaucracy, filling out duplicate paper forms, and bribing guards just to get a single motorcycle into the country.
That told him everything he needed to know about that nation's supply chain.
Right. Because if a tourist on a bike can't get through, a fleet of commercial trucks carrying export goods certainly isn't getting through efficiently.
Man, capital hates friction, doesn't it?
Precisely the point. If goods cannot move, if commerce is choked by corruption and red tape at the borders, the domestic companies inside that country are going to be strangled.
Regardless of how good their actual products are.
Exactly. But on the flip side, if he crossed a border in a matter of minutes, found paved, well-maintained roads, and saw ports actively expanding to handle more shipping containers.
Then he knew the underlying infrastructure was actively being primed for economic velocity.
Yes, and the currency markers he looked for are just as fascinating. He wasn't looking at the official government exchange rates printed in the Wall Street Journal.
Right, he was looking at the black market, wasn't he?
He was. If a government officially claims their currency is pegged at 10 to 1 against the US dollar, but the guy on the street corner is offering you 100 to 1.
Then the official numbers are a complete fiction.
Exactly. The street corner is the real economy. That delta between the official rate and the black market rate is a real-time measure of inflation and institutional trust.
Something you will never find in a sanitized analyst report.
Never. It fundamentally changes what you're looking for as an investor. Most people approach markets by asking a very specific, narrow question, which is usually, what stock should I buy?
They're hunting for a golden ticket, like one specific company that will outcompete its rivals.
Right, but the ground-level approach requires a much broader macroeconomic question. You have to ask, what is happening in this country as a whole?
Okay, here's where it gets really interesting, because I want to push back on this a little bit for the sake of anyone listening.
Sure, go ahead.
Analyzing an entire country's macroeconomic infrastructure, its education system, trade agreements, currency controls, I mean, that sounds completely paralyzing for a normal investor.
It can definitely sound overwhelming.
Right. Wouldn't it be immensely safer and easier to just read a company's balance sheet?
Right.
Like, why analyze the entire ecosystem of a foreign nation instead of just chasing the momentum of a hot tech stock that already has a proven product?
Because investing in a brilliant company operating inside a failing country is basically like putting a Formula One engine inside a car with square wheels.
Oh, wow. Okay, the engine is a masterpiece, but the vehicle won't let it move.
Exactly. The ecosystem dictates the ceiling of success. You can have the most visionary founder and a flawless product. But if the government suddenly imposes strict capital controls—
Meaning that company can't convert its local currency to dollars, right?
Right, meaning they can't buy the raw materials they need to manufacture their product, so the factory shuts down.
The balance sheet looked great yesterday, but the macroeconomic weather just destroyed the business.
Yep. The macro environment is the soil. If the soil is toxic with hyperinflation and corruption, the crop fails.
But if the soil is rich, it gives you an asymmetric advantage.
It does, and we should probably define that, because an asymmetric advantage is really the holy grail of investing. It means your potential upside completely dwarfs your downside risk.
So when you find a country that is, say, quietly paving thousands of miles of new highways, lifting currency controls, and balancing its budget—
You don't actually need to be a genius at picking individual stocks. You don't need to guess which specific trucking company is going to dominate those new highways.
because you just know the entire logistics sector is about to experience a massive tailwind.
Exactly. You just buy the whole market. You invest in the inevitable result of that ecosystem improving. A perfect historical example from his journey was Botswana in the early 1990s.
Right, the surrounding nations were really struggling at that time.
They were severe instability, debt crises, failing infrastructure. But when Rogers crossed into Botswana, the contract was immediate. The roads were immaculate. The government was running a budget surplus.
Which is a huge indicator.
Massive. They had massive foreign exchange reserves, and most importantly, there were no restrictive exchange controls preventing capital from flowing in and out.
So it was a functional, thriving ecosystem entirely surrounded by chaos.
And yet, because of the geographic association with its neighbors, the global financial community was largely ignoring it. The market was incredibly cheap.
So he didn't agonize over picking one or two winners?
No, he basically bought shares in every single company listed on the Botswana Stock Exchange. He bought the ecosystem.
And as global capital eventually recognized what he had seen on the ground—
That market experienced a massive, multi-year boom.
See, that brings up a glaring problem, though. So what does this all mean for human psychology? Because if you're doing this properly, looking at the macroeconomy first and finding a secretly booming country before the mainstream catches on—
It means you're investing in a place that most people think is a terrible idea.
Exactly. You are literally walking into markets that are deeply unpopular.
But the greatest profits are inherently tied to unpopular places.
Hmm.
It is a structural law of financial markets. When an investment is universally loved, when your neighbor and the financial news networks are all talking about how great a particular asset is.
All of that optimism is already priced in,
Right.
meaning the price of the asset has already been bid up so high by everyone buying it that the future growth is already accounted for in today's price. There's no bargain left.
Yeah. Exactly. The upside is capped, but the downside is immense if the company stumbles even slightly. To find real explosive value, you have to look where sheer fear is dominating the narrative.
The opportunity begins where the crowd refuses to look.
It does.
Let's talk about the actual mechanics of that fear, though, because it goes against every evolutionary survival instinct. We have to walk towards something that everyone else is running away from.
Oh, absolutely.
If the herd is stampeding away from a market, our brains are wired to run with them. Why does fear create such reliable opportunities for someone observing the ground truth?
If we connect this to the bigger picture, it really comes down to forced liquidation and the mechanical nature of a financial panic.
Okay, break that down for us.
When a country hits a crisis, say, a currency devaluation or a political scandal, institutional investors and massive funds often panic. But more importantly, they are often legally or structurally forced to sell their assets.
To meet margin calls or client redemptions?
Right. Yes. They aren't selling because the companies are bad. They're selling because they need cash immediately to cover other losses.
So that mechanical forced selling is what creates artificial discounts.
Exactly. You have perfectly healthy businesses operating in an ecosystem that might just be experiencing a temporary shock, being sold off at pennies on the dollar because the institutional holders need liquidity.
The asset's price becomes completely divorced from its intrinsic real-world value.
Which is exactly what happened with Rogers in Austria. The Austrian stock market is a brilliant example of this contrarian mindset in action.
Right, because for decades prior to the 1990s, the Austrian stock market was essentially dead.
Totally ignored. Global investors considered it stagnant, overregulated, and uninteresting. It was universally unpopular. But Rogers looked at the underlying ground-level mechanics.
He literally looked at the map.
He looked at the map and he looked at the policy shifts. The Iron Curtain was falling. Eastern Europe was opening up for the first time in half a century.
And if you look at a map, Austria is perfectly positioned geographically and culturally to be the gateway for all the capital and trade flowing into Eastern Europe.
Furthermore, the Austrian government had just started quietly cutting taxes and reforming their capital markets to encourage investment.
So the soil was being heavily fertilized, but the global financial community was still operating on the outdated, latency-heavy belief that Austria was a stagnant, dead market.
The crowd was anchored to the past, while the physical reality of the present had already changed. Rogers recognized this massive disconnect between the narrative and the reality.
So he invested heavily in the Austrian market before anyone else cared.
And shortly after, as the capital flows into Eastern Europe accelerated, the Austrian market exploded in value. He saw the structural shift before the narrative caught up.
But weathering that disconnect between the narrative and the reality requires a frankly terrifying amount of conviction.
Oh, it really does.
I mean, it's one thing to see a paved road and think, hey, things are looking up. It is entirely another thing to wire millions of dollars into a market that the rest of Wall Street thinks is a joke.
And then just sit there, totally alone in your thesis.
Exactly. How do you stomach the psychological toll of being that lonely in a trade?
Well, you only survive that psychological isolation if your conviction is built on relentless curiosity rather than arrogance. You can't just be a contrarian for the sake of being annoying.
Right, doing the opposite of the crowd just to be different is a great way to lose all your money.
Exactly. Your contrarianism has to be rooted in a deep, insatiable curiosity about how the world actually functions mechanically. You have to constantly ask why.
Why is the black market currency rate diverging from the central bank rate? Why is this specific port expanding while the neighboring country's port is rusting?
Curiosity forces you to gather proprietary data. When you have asked the right questions and you have seen the tangible, physical proof that a country's ecosystem is improving.
The paved roads, the eased border frictions, the busy factories.
Right. Then your conviction isn't based on a gut feeling. It is based on structural reality.
Yeah.
And that deep reality-based conviction is the only thing that allows you to deploy the most difficult weapon in investing.
Patience.
Absolute, unwavering patience.
Yeah.
The crowd is always late because institutional money is slow. Massive pension funds and international investment committees take quarters, sometimes years, to approve a new country allocation.
They have endless meetings. They wait for the mainstream analyst reports to be published.
And they wait for the economic data to be revised and confirmed by major institutions.
So by the time the committee finally signs the paperwork, the guy who rode through on the motorcycle has been sitting there for 18 months.
Exactly. And that waiting period is where most people fail. This raises an important question about how we actually tolerate waiting, because impatience destroys more capital than bad analysis.
People do the research, they find the hidden value, they buy the asset, and
It
then
only happens for 6 months. The price might even drift lower. And because they are operating in an environment of instant gratification, they panic.
they assume they must be wrong because the market hasn't instantly rewarded them.
So they sell at a loss, only to watch the market soar a year later when the institutional money finally arrives.
The mechanics of patience in macro investing are so often misunderstood. I love the analogy of planting a tree here, especially when applying it to modern life for you listening right now.
It's a great analogy.
Because in an era of instant notifications and gamified apps, doing absolutely nothing feels like a failure. It feels like you're doing something wrong.
But because the crowd is late, if you've done your independent research, doing nothing is often the smartest decision. Patience beats constant action.
Right, investing is like planting a tree. Growth takes time, and wealth is built over years. You wouldn't plant a seed and then dig it up 3 days later to check if it has roots.
Exactly. The capital flows will eventually follow the infrastructure, but they will not do it on your daily schedule. You have to let time do the heavy lifting.
And understanding that latency is really what separates the people who build generational wealth from the people who are just gambling on the news cycle.
Which is why the timeless takeaways from Investment Biker are arguably more vital today in our era of extreme information overload than they were in the 1990s.
We have more data at our fingertips than ever before, but we have less actual ground-level truth. We're drowning in noise and starving for reality.
So the mandate is pretty clear. Do not blindly follow the sanitized headlines. Question the filtered data streams. Think globally and look for the physical, mechanical signs of improvement that algorithms just cannot capture.
A busy port, a rapid border crossing, a balanced budget in an ignored region.
Look beyond the obvious narratives. And when you find the disconnect between what the crowd believes and what reality is actually doing, have the conviction to position yourself and the patience to wait for the world to catch up.
Opportunities are rarely going to appear where everyone is already looking. You have to get out of the skyscraper and onto the dirt road. And I think that brings us to the ultimate shift in perspective here.
Definitely.
Yeah.
Because the greatest message isn't even about money. It's about perspective. The world is infinitely more complex and fascinating than your hometown, your preferred news channel, or your portfolio would have you believe.
Yeah.
Every time you cross a border or observe how a different culture solves a logistical problem, you are pulling back the curtain on how human civilization actually operates. Every culture and journey teaches you something valuable.
Making you not just a better investor, but a better human being.
Exactly.
Which leaves us with a final thought for you to carry with you today. We've spent this entire deep dive exploring how the greatest hidden value is consistently found in places where people refuse to look, usually due to fear or a lack of interest.
Right.
So take these mechanics and apply them outside of the stock market. What is an area in your own life, your career, or your local community that everyone else is currently ignoring?
The unpopular project or the unglamorous department.
Exactly. What is everyone running away from right now, which might just be your biggest hidden opportunity waiting to be discovered?
Because the real value is usually found in the friction the crowd is trying to avoid.
We'll leave you to think on that. Until next time, keep exploring.